Hey everyone, welcome to Thursday. Now, normally we would do share and review, but this time I have had a fantastic question come in from a listener, and I thought let's address it here because there may be others that want to know the same question. So, that is, I would like to have a diversified portfolio of New Zealand listed securities being made up of equities, debt, commodities, and they're open to anything else listed on the New Zealand Stock Exchange, etc. Their idea is for a long-term hold, capital gains and dividends, and they're asking, is there any ideas I can suggest or any suggestions on proportion sizing of holdings, maybe some securities which would consistently perform well over the long term? Now, that's a really, really good question. So in light of that question, the first thing I want to say is you are actually seeking financial advice, and I would recommend that you go and have a chat to a financial advisor. You can certainly look them up just by Googling them in your area. Now, if you're actually thinking, I want to do something myself and learn about it, then that's great. I'm going to show you some tools. So first of all, we're going to go and have a look at the Sorted website. Right, here we've got the Sorted website. So the first thing I would suggest doing is clicking on the Tools tab at the top, and you can go and have a look and find out what sort of investor profile you are. So let's click on that one. Okay, now this investor profiler, by going through and answering a series of questions, there's not many of them, will help give you an indication as to whether you are an aggressive investor, a growth focused, balanced, conservative or defensive. So let's run through that and we will make up somebody. So here we've got the first question. The most important thing to me when investing is, and obviously if I perhaps answer this person's question, it's probably B, almost certainly ending up with more than I put in despite some ups and downs along the way. So let's click B. Second question, I'm investing, and I would suggest that this person is saying to grow my money generally over time. Now, I'm only guessing these answers. They're not specific to anyone at all. I encourage you to do it yourself. I'm demonstrating how this can be done. So I want to use the money I'm investing in the next, let's say for the purpose of this, it's 10 years or more. If I had $100,000 invested and I experienced a loss during a year, I would start feeling really uncomfortable when my balance fell too. Now, I'm going to say 10% in this example because in the question, the person was looking for something that generally is going to keep going up. Now, if you're looking for something that's going to keep going up in security, you're probably looking for a term deposit. However, term deposits will not keep up with inflation over the long term, and we've experienced that. So let's say that you cannot experience too much volatility, maybe 10%. Currently, I have close to this amount of debt. So I'm going to really take a guess. Let's go A, debt worth more than I earn in a year. Again, I'm going to guess here. If I was to lose my day-to-day income, I have, let's say that I've got some insurance or savings that would help. And I see my security of my finances, job or business over the next 5 years as, let's just go satisfactory. Right. It's come down here that our investor is potentially a growth-focused investor. Okay, and over here on the right-hand side, the darker line is just sort of showing where a growth investor could perhaps experience a return over the next 25 years. Okay, so if they started down here with about $10,000 and about 25 years, taking into account ups and downs, you could have about 117 thereabouts. Right, now if I scroll down, it does talk about a little bit more about the growth focused investor. And if I look at the returns here, it's saying here that you could potentially experience a 7% return on average. However, the range could be anything from -5% out to a 20% return in any 1 year. And we do have that happen. And in fact, it says here that you could experience a negative year in every 5.9 years. And there's a 2.5% chance that it could be in the next 3 years. And if, to be honest, this year could well be negative, especially at the moment. Right, now this is a really good part. This is what generally makes up a portfolio for a growth investor. And you can see here that 68% of it is invested into share market, 7% into property, 20% into the bond market, and 5% into cash. And then if you look, it will actually break down what each area means. So obviously shares, it means you're buying a slice of the company and you'll receive part of its profits as dividends if they pay it out. Okay. And obviously if the share price climbs, then that's going to reflect in the value of the portfolio as well. Now, if I just go down a little bit, now if I click on this one here, it says explore funds with a similar mix on Smart Investor. So let's view the funds. Right. We're just looking at managed funds because we're not including KiwiSaver in this one. So let's leave it selected as managed funds. It's highlighted growth because that was what our profile came out as. And here it goes. It actually lists, it's got 63 different funds available and it's just listed them, I think in alphabetical order it has. So ASB Investments have one, Lifetime Retirement Funds, Salt Investments, New Zealand Funds Management. So there's all different fund providers that you can look at. Okay, now I've just scrolled down here. We've got ANZ up here. So if I click on the ANZ Balanced Growth Fund, and you do have to do your own research here. I've just selected them only because I was on them when I was giving you a demonstration. So it will show here roughly as to what the asset allocation mix is. So 66% is going to be in what referred to as growth assets. So that's your share markets and property. And then 34% is going to be in income assets, which are your bonds and your cash. The fees on this particular fund is 1%, and the returns over a 5-year period has been around 4.4%. Okay, but it says under here that the average for a fund in this nature is around 5.69. So this one is perhaps a little bit underperforming that. But just remember as well that this year's top performing fund might not be next year's. Okay, it could be the bottom fund. I've seen that happen before, and vice versa. Right, then it goes on to product disclosure statement, which is really important to read that. I can keep scrolling down, and what it will show you is it will show the mix of the assets. So it's showing about how much is invested into shares, as you can see there, 58%, how much property, other, which is usually other is made up of things like commodities and alternative assets. So there could be things in there like contracts for different CFDs, there could be currency, all of these sorts of things, bonds and cash. Now, if I scroll down further, it does show you as to where the top 10% of the investments are. And you can see here the Fisher & Paykel Healthcare, it's under Australasian shares, and it's got 1.3% of your money is invested, or the fund, which equates to your money as well, as invested in Fisher & Paykel Healthcare. And you can see that's an Australasian share. And obviously there is Apple, which is international, and it just keeps breaking it down. So this is a great way to get diversification in your portfolio. And it's also a great way that you don't have to watch it. You don't have to think, my gosh, this is what's happening in the market. Should I be making changes? Okay, so this is why you'd either need to speak to an advisor or do your research from here on the sorted investor profiler. Right, and then it goes on to fees, how it's broken down, and everything like that. Now I'm just going to take these ones off, and I'm going to also show you, I've shown this one before. This is called Smart. It used to be called SmartShares. Now, if you're the sort of person that wants to do research and do it yourself, you can actually use some of their funds here. So let's click on Invest with Smart. These are what they refer to as exchange traded funds. So these are funds that are made up of companies that are on the stock exchange. Okay, so you can invest directly with Smart, or you can actually buy their funds on the New Zealand Stock Exchange. Okay, so let's find funds. If I click on funds, click on explore ETFs. So if we were looking at New Zealand shares, it comes up with the fund that it's in and what we refer to as the ticker code. So that's the ticker code that I quite often will put in when I'm doing a share and review on Yahoo Finance. So that's what you can find here. And if you click on each of them, it will break it down. So with, for example, the NZG fund being the top 50 companies on the New Zealand Stock Exchange, that one there has a weight to exactly how the top 50 companies are weighted on the stock exchange. Whereas the other one, the FNZ one, underneath it, it will only have a maximum of 5% holdings per company that's listed on the top 50 companies on our stock exchange. Now, there's obviously fors and against, because if under the NZG, this fund will mirror exactly what the whole board is doing. So if one of our top performers like Spark, for example, is performing really well, then obviously that is going to have more weight in this NZG fund. Whereas if it's doing really well but not so much some of the other companies, then under FNZ it won't have as much return, if you like, or benefit. But there's always swings and roundabouts for everything. So it's again about doing your research. Now, another thing you can do is you can click on property, and again, there is a property sector here for New Zealand shares. So you can click on NPF. If I just go back to thematic, there are not a lot of commodities available under the ETFs. However, there, as you can see here, if you're into robotics, Bitcoin, gold, any of these, there are the ticker codes that you can invest in here. Okay, again, you do have to do your research. Then if I scroll down, here we've got the bonds and cash part of the portfolio. So we've got New Zealand global bonds, if you're wanting to just stay in New Zealand. And then we've got obviously corporate bonds, which are down here, and we've got cash market as well, NZC. So those are some ways that you could make up your own portfolio based on your risk profile. If you didn't want to go and use a fund manager and you were looking at investing in such a way that you didn't have to keep a hands-on approach. Now, what I would suggest certainly looking at doing, if you're going to look at doing something like this yourself, go through, do the risk profiler that I talked about on the Sorted website, see what type of investor you come up as, go and have a look at some of those funds and see how they're invested, i.e. how much is invested into New Zealand equities, that sort of thing. Because remember too, New Zealand equities are a very, very small part of the world market. And it's really important, I believe, to have exposure globally. However, by doing that, if I've just scrolled back up to the international shares, you can invest globally through SmartShares. And again, so it's all domiciled back into New Zealand, even though you're going to have exposure to some of these other countries or areas around the world. So you could make up your portfolio based on the same percentages as what perhaps in my example, a growth investor had in one of those managed funds. What I would recommend that you do though is every 6 months review it and redistribute it. So if, for example, the shares have started outperforming and you want 60% of your fund invested into share markets and the shares have been performing really, really well, and let's say it's become disproportionate and suddenly that's at 80%, then to keep it balanced, you should really look at rebalancing it, bringing it back to 60, so selling 20, and obviously putting that money back into the bonds and cash market. Really complex topic here, and I'm happy to help. I've got a lot of experience in this area, but these are just ways that you can look at doing this yourself without obviously seeking advice from someone. So SmartShares, or Smart as they're now called, can be a great way to do it. Otherwise, if you're thinking, hey, I just want to be able to do this, I want to be able to talk to someone and invest my money appropriately, then definitely you do need to go and have a chat to a financial advisor. So it's a great question, great topic, and I'm really pleased that this person asked that, and I'm happy to help. So if you've got anything else that you would like to know, I'm happy to address it here, or obviously reach out to me and I can help talk you through some of these things one-on-one. So until next week, take care.